Comparative Analysis, Dolby Laboratories, and EchoStar Incorporated by John DiFuria and Luis Ibarra. Today we'd like to discuss the financial analysis of Dolby Laboratories versus EchoStar Corporation. We'll cover several important areas such as who our shareholders are, what our cost of capital is, if financial restructuring would benefit each of our companies, who our competitors are, and the overall value of our firm. After covering these areas, we'll be able to fully understand each company and its worth to the market.
Who are our shareholders? Shareholders are an important part of any company because they are the owners of the company. By shareholders investing their cash, they contribute to the company's finances, operations, and are a large part of the overall consideration of the company. Dolby currently has 46 million shares outstanding. Institutional ownership owns 97.4% of the company, and the top 10 institutions currently own 57.2%. On the right-hand side, under the institutional name, there are two companies that own part of both companies, and they are the Vanguard Group and BlackRock Institutional Trust Company. This slide shows who the shareholders are of EchoStar Incorporated. Right now, they currently have 40 million shares outstanding. 82.6% are owned by institutional ownership, and the top 10 institutions own 52.2%. On the right-hand side, once again, you'll see the Vanguard Group and BlackRock Institutional Trust Company come up on the list. After reviewing both major holders' breakdown from Yahoo Finance, we came to the conclusion that Dolby Laboratories has 12% of their outstanding shares are owned by insiders compared to EchoStar's 1% outstanding shares being owned by insiders. Dolby's board of directors owns a fair amount of shares, showing that they have a stake in the company and hold a higher interest in the company's performance. EchoStar CEO Charles Ergen is the only major holder on the board of directors.
Why do investors care about our cost of capital? Capital structure is quite important for a company to be able to perform day-to-day operations. It also shows how a company will be able to finance future projects and investments in growth potential. When people refer to capital structure, they are most likely referring to a firm's debt-to-equity ratio, which provides insight into how risky a company is. A company that is more heavily financed by debt possesses greater risk. Some determinants of debt advantages and disadvantages are tax rates. The tax rate has a direct impact when it comes to tax savings. If the company has a fairly high tax rate, the optimal debt ratio is also high, since the tax savings increase by the company taking on more debt. The tax rate for EchoStar was 35% with an optimal debt ratio of 0%. Dolby also has a tax rate of 35% with an optimal debt ratio of 60%. Dolby has the ability of handling and taking on more debt since they have a low debt to equity ratio compared to EchoStar, who will be taxed less since they have a high debt to equity ratio. The ability to pay interest. If the company has the ability to pay interest easily, they are more than likely able to take on more debt. Dolby Labs have an interest coverage ratio of 1,846.94 compared to EchoStar's ratio of 5.65. This means that Dolby Labs has no debt compared to EchoStar and could more easily take on more debt. Variance in operating income. The beta of the company reflects default risk. If the beta increases, the higher debt ratio increases as well as the cost of equity. The variance also influences the bond rating, which ultimately reflects the interest rate of the bond, probability of going bankrupt, and the cost of bankruptcy. This gives an overall impression of how flexible the company will be in the future. The higher the probability and cost of bankruptcy, the less the optimal debt. Dolby Labs has a current beta of 0.93, and the optimal debt ratio would be 1.83. Dolby Laboratories beta increases at optimal debt if they take on more debt, making their stock more risky than it is. EchoStar has a current beta of 1.18, and at optimal the beta would decrease to 0.85. This means that due to their high leverage and having a high debt ratio, puts them at a higher default risk. Future projects. If the companies have future plans for growth and expansion, the optimal debt ratio should be lower to allow for future borrowings. Companies that operate where projects earn higher returns than their hurdle rate should value flexibility of the company. Therefore, the preferred company based on capital structure would be Dolby Laboratories. It is in their interest to increase their capital spending, which can finance future projects and other long-term investments. As seen in the table, Dolby Labs can increase the value of their firm to $3.65 billion and also increase the value of their stock.
What is our cost of debt financing? This slide only provides the cost of debt pre-tax. Debt financing is an important measure because it can give investors an idea as to the riskiness of the company compared to others, because riskier companies generally have a higher cost of debt. It can be broken down into two sections: the cost of debt pre-tax and the cost of debt after tax. Cost of debt pre-tax signifies the amount of interest paid on a loan without taking out tax deduction. It can be found by adding the default spread to the risk-free rate. The risk-free rate is found using the U.S. 10-year constant maturity rate, and the default spread is found by correlating the company's credit rating to the default spread ratings of large similar firms. Dolby Labs, we use a 2% risk-free rate for the 10-year U.S. bond. We use a default spread of 1.15, which gave us a pre-tax cost of 3.15%. For EchoStar, we use the same 2% risk-free rate, but since they had an increase in their debt, we assumed a lower bond rating of a double B, which then made us give a 2.5% spread, which added up to a pre-tax cost of 4.5. And as looking back over to Dolby Labs, we assumed a double A bond rating, even though both companies did not have any bonds currently. We took it in consideration of what their debt equity ratios were and how much more borrowing they could do. This next slide here provides the cost of debt of financing after tax. We took the 3.15% and multiplied it by 1 minus the tax rate of 0.35, and it gave Dolby Labs an after-tax cost of debt of 2.05%. The after-tax cost of debt for EchoStar, we once again took the 4.5% and multiplied it by 1 minus the tax rate of 0.35, which gave us 2.93% after-tax cost of debt. Dolby Labs is preferred since they can take on more debt. Their financial statements reflect their ability to have more cash on hand to finance future investments more easily. Dolby has 12.29% of debt to total assets, making them able to take on more debt if needed. EchoStar is a company that currently has a high long-term liabilities than they do equity, and are at a 54% debt to total assets. Their tax rate, effective tax rate, is lower due to low net income and accumulated debt. When running the capital asset pricing model for Dolby, we took the 0.02 risk-free rate and we added that to the 0.9477 beta times 0.075 return on the market minus the risk-free rate of 0.02, which equals 7.21%. This was regression that we ran off the 5-year monthly return. The alpha came out to negative 0.31, the beta came out to 0.9477, and the R square came out to 23.71. The 23.71 is a percent of the risk that comes from the market, which consists of the interest rate risk and inflation risk and others. The remaining portion is 76.29%, which can be attributed to the company's specific risk, which is diversifiable and therefore not rewarded in the CAPM. The standard error of the beta estimate equals to 0.0942. Under the normal distribution, the true beta for DLB could range from 0.7593 to 1.1361 with a 95% confidence level. This slide here shows Dolby Laboratories' 2-year weekly return compared to the S&P 500 market. The alpha came out to be negative 0.0078, the beta was 1.079, and our R square was 23.95. This is at a total of 105 points. Standard error is listed at the bottom. Dolby Labs' 2-year weekly beta calculated out to 1.079, and its returns are plotted in the right side chart on the y-axis against the S&P 500's returns on the x-axis. Dolby Labs had an increase in beta from 0.9477 for the 5-year monthly regression to 1.079 for the 2-year weekly regression. This increase in beta suggests that DLB has more risk exposure in the short term compared to the long term. Now we're on to EchoStar Incorporated. The graph on the right shows EchoStar versus the S&P 500 on a 5-year monthly basis. The CAPM, the capital asset pricing model, computed out to 7.02%. And on the 5-year monthly return for EchoStar, running regression, the alpha came out to 0.71, which is the slope of the line, and the beta came out to 0.9131. The R squared came out to 15.04%. 15.04% of the risk comes from the market sources, interest rate risk and inflation risk and others. The remaining portion is 85%, which can be attributed to the company's specific risk, which is diversifiable and therefore not rewarded into the CAPM. The standard error of the beta estimate equals to 0.1202. Under the normal distribution, the true beta for EchoStar could range from 0.6727 to 0.1535 with 95% confidence. This slide provides EchoStar versus the S&P 500 on a 2-year weekly basis. The alpha came out computed to be 0.0021, the beta came out to 1.327, and the R squared came out to 39.56%. EchoStar Corporation's 2-year weekly beta is calculated at 1.32, and its returns are plotted in the chart on the right on the y-axis against the S&P 500's return on the x-axis. EchoStar had an increase in beta from 0.913 from the 5-year monthly regression to the 2-year weekly regression of 1.33. This increase in beta suggests that EchoStar is 33% more volatile than the market and also could operate more efficiently in the long run. What is our overall cost of capital? Cost of capital plays an important role in businesses to evaluate themselves because they require capital to build new property, plant and equipment, acquire other companies, expand internationally, and keep up to date on information technology, among other things. And in order to do these things, the company must evaluate whether the expected rate of return exceeds the cost of capital. By looking at the figures on the left, you can see how we calculated out our debt and equity ratios, and the cost of capital is the weighted average cost of equity, debt, and preferred stock. The debt ratio for Dolby is 0.64%, and for EchoStar is 45%. The equity ratio for Dolby is 99.36% and 55% for EchoStar. Neither company owned any preferred stock. The cost of debt for Dolby was 2.05 and it was 2.93 for EchoStar. Cost of equity for Dolby was 7.21 and 7.02 for EchoStar. There was no cost of preferred stock. When computing out the WACC on the bottom right hand side, for Dolby Labs it came out to 7.18% and it was 5.18% for EchoStar.
This slide shows the capital structure for both companies, EchoStar and Dolby Laboratories. The company that is preferred if they change their capital structure would have to be Dolby Laboratories. They have the ability to increase the value of their firm by increasing their debt and using their cash to finance any projects or long-term investments. This will also decrease their WACC, which will reflect in their stock price as well as a high enterprise value. EchoStar is currently highly leveraged and cannot take on any more debt. Even though they have a lower WACC, this will eventually increase as the debt is paid off and revenues increase. They have lack of free cash flow.
How would a financial restructuring affect the value of our company? Dolby Laboratories, off of the table on the previous slide, the optimal is 60% debt equity ratio, which would increase the firm's value to $3.652 billion, which gave a net gain of $496 million. The optimal beta would then be 1.83. We feel this is not quite optimal for them, since their beta would go from 0.9477 up to 1.83 and make them a little bit more volatile. So we would suggest that the optimal debt equity ratio would be somewhere between 25 and 35%. For EchoStar, the optimal debt equity ratio is 0%. This is due to them being highly leveraged at the time, and they need to currently pay off some of their long-term debt due to project expansion and capital expenditures that they have done over the past couple of years. Their firm value would then go up to $10.06 billion, which would be a net gain of $2.187 billion, and this would lower their optimal beta down to 0.85%.
Would more debt create unnecessary risk? With Dolby Labs taking on more debt would be a positive thing for the firm since they have minimal debt. They also have enough cash and short-term investments available to them to finance any future projects and possibly taking on more debt without any risk up to 50%. For EchoStar Corporation, they could face hardships if they take on more debt. It would definitely be a risk since they have a short amount of cash on hand, and due to their capital spending and debt they have taken on within the past year. They are in no position for future projects since they have heavily spent on current projects that they are currently working on now. What does the competition do? When it comes to the competitors in the same industry as Dolby Labs and EchoStar, we realize that Dolby Labs percentages are more closely related to the competitors compared to EchoStar. The total current assets for Dolby Labs are 49.48% compared to EchoStar that has current assets of 35.26%. Their competitor, which is DTSI, has a total current asset percentage of 60.26%. This gives DLB an edge over EchoStar by having more cash on hand to fund future projects and long-term investments. With long-term assets Dolby Labs has 50.52% of their assets that are tied up for long-term compared to EchoStar, which has 64.73% of their assets tied up to long-term. DTSI has 39.38% in long-term assets. We feel that Dolby Labs has a better mix of short-term and long-term assets compared to their competitors. Both companies have similar current liability percentages, but when it comes to long-term liabilities, there is a huge difference between the companies. Dolby Labs has 4.27% of long-term liabilities compared to EchoStar's 44.58% of long-term liabilities. Dolby is more aligned with DTSI Incorporated, which has 4.95% of long-term liabilities. Dolby Labs shareholders' equity is 87.73%, and EchoStar has 46.5% of shareholders' equity compared to DTSI, who has shareholders' equity of 91.43%. Dolby Labs has a long-term debt-to-equity ratio of 4.86 compared to EchoStar's 95.89% and DTSI 5.41%. This shows that EchoStar is currently maxed out on their leverage due to them having as much long-term liabilities to shareholders' equity. Is our stock prices fairly valued? Dolby Labs' most recent stock price was listed at $31.73 per share. The intrinsic value of stock per share was listed at $33.78, which means that the current stock price could be undervalued. EchoStar's most recent stock price was listed at $38.89 per share. The intrinsic value of stock per share was listed at $50.78, which means that the current stock price is undervalued. We strongly believe that this stock is undervalued because they have recently increased their capital spending on future and long-term investments, which will give them the edge of a higher growth rate compared to Dolby Labs.